We're going to talk about the health benefits of budgeting. See, you think this is purely a financial show here on Dollars and Cents. Oh, no, we're going to give you some health advice as well. But it is, of course, correlated to something financially important, which would be budgeting. Also, we're going to talk about the latest on the employee retention credit. If you remember, that's the big tax credit that came about as a result of some of the COVID legislation. It inadvertently spurred a bit of a cottage industry where there were a number of firms that sort of popped up that tried to convince a lot of small businesses out there to apply for this employee retention credit. Many, unfortunately, did, and only to find out that they probably weren't eligible for that credit. So on the program, we're going to talk a little bit about what that credit is and what the eligibility requirements are and why you may want to listen up to the latest out of the IRS regarding this particular tax credit. Of course, for all of these topics, budgeting and taxes, we're joined this week on the program by fellow certified financial fiduciary Christina Lamb. How are you this morning?
I'm doing well. Good morning, everyone.
Very good. And so Christina is an IRS enrolled agent as well, been with our firm for a number of years. We won't say how many. And so we're excited to have you once again on the program to talk about these topics. And of course, the start of the year, I guess as we get deeper into January, means that we are gearing up for another exciting tax season. I know you're super excited about it, right?
It is always fun, Phil, and nonstop.
There you go. Well, we've sent the organizers out, right?
Yep.
So that's kind of the first step.
Last week for existing clients, they should have already received those.
Perfect. So that's kind of the first step in the process. You get your organizer. That's a great place to start, right? So the organizer is just as it suggests, it kind of helps you get organized, right?
Yes, please look at your organizer if you are a Nelson Financial Planning tax client. It will help you gather everything and also, more importantly for you, expedite your process of getting your tax return done, because the more complete your package is when it comes to us, the quicker we can roll it through.
So that is good stuff. What that also kind of highlights is I saw an article here a couple of weeks ago about how tax season in and of itself represents a bit of a shortfall or a shortcoming in the financial advisory, financial services, financial planning industry. This industry has so many different labels. I thought I would try and jam them all in there at one shot. But based on a recent survey, Christina, 90% of households with more than $250,000 in assets want tax planning advice as a part of the financial services they receive, which sort of makes sense, right?
Yeah, absolutely. I thought that was a very interesting topic, and information from the survey that that is becoming more important to clients.
Well, and after all, let's not forget, you only get to spend what you get to keep after taxes. It's always about the net, not the gross. And what was interesting about this survey, Christy, is that the notion of tax advice and tax strategy actually jumped to the #1 spot ahead of even retirement planning in terms of what services consumers want from their financial advisory or financial planning firm. So an interesting sort of change in what the consumer wants even relating to the tax services.
Sort of as it should be.
Right.
Tax planning is important. And I think one of the things I've seen with the number of years I've been in the industry that we won't mention is that clients who come in, their questions have changed. They are way more educated about the investment questions they're asking, which is why I think it leads to this tax strategy is so much more important to them, and they're asking for it and they're demanding it.
Well, that's a great point. And the crazy thing is that, for most people dealing with large financial institutions, you look at those statements, take the year-end statement that you would have just gotten here at the end of the year, and in the fine print, you always see the standard disclosure that XYZ firm does not provide tax advice, consult your tax preparer. I mean, that's just, every time I see that, I kind of think, well, that's just kind of bizarre when you think about, getting a statement from a financial company, and it's where your investments are, but yet they're not interested in really having any level of responsibility to stand behind the tax advice that they are delivering.
I have to agree 100%. It drives me crazy when I see that. People have their money invested. They're trusting these advisors, as you said, for financial planning. Finances don't include, as you said before, just the investment portion. It's how it's taxed and how you use it, how you take money out. There's so much more to your finances than just the investment portion.
Right, which obviously for us at Nelson Financial Planning, that's kind of one of our, I think, key uniques out there in the industry as a whole. I mean, we've certainly been doing tax returns here at the office for well over 20 years. Got a lot of experience at the office, and certainly a full team of folks as well that serve to help provide that accurate level of tax advice.
Yeah, not only do we have our tax department, which is about like 6 people now, which has grown substantially since I've been here. All our advisors also can help give advice on the best places to take money and how much tax withholding you should take and things of that nature that would affect your tax return.
Well, and one of the things that I think is so important, look, there's so many nuances of the tax code these days that you really need sophisticated tax preparation, tax return software to really run that accurate projection that people are looking for. It's just that's not enough to be, kind of estimating or guessing on it, because you can get a lot of ripples depending upon kind of how the actual numbers go through that tax preparation process.
Yeah. It's not just about adding the income to your return. It's about, is it going to affect Social Security? Is it going to draw the net investment income tax? Is it going to affect any of your itemized deductions which may be income based? So many factors.
Right. Another one that we see sometimes for folks is, and nobody likes it, is when their Social Security check drops because they're having to pay.
They don't get it, and they're so mad.
Right. And oftentimes it's one of those things where if income just trips the thresholds, then you're going to pay more for Medicare, which means that your Social Security check is going to go down. The other thing that we hear and see a lot about is kind of this notion of, particularly some of these advertisements that talk about, oh, don't you want a tax-free retirement? Okay.
Yes, please.
Yeah. Well, sure. I mean, who wouldn't want that? But what these ads fail to talk about when they emphasize tax-free retirement is what do you have to do to kind of get there? And it certainly sounds amazing. Everybody would want it, but there's certainly a catch. And what these ads are obviously talking about is the difference between a traditional IRA versus a Roth. So let's take a second and pause. And what's the difference, Christina, sort of between that traditional versus the Roth?
Right. So traditional IRAs have deductible contributions, where Roth IRAs have non-deductible contributions based on your tax return. Both of them for 2024, you can contribute $7,000, plus $1,000 catch up if you're over 50. And then one of the important options on the Roth is that there are income limits to how much you can make to be eligible to contribute.
Right. And clearly the IRA, you get the tax deduction going in. When you take it out, it's taxable. Mm-hmm. When you do the Roth, then it's an after-tax contribution. When you take the money out, it is tax-free. We're going to talk more about that distinction and sort of what this all means to have a tax-free retirement and sort of understand the implications of of that, because it's not enough to just offer it. You have to understand the cost to get there. So all of that will be our topic coming up next here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. Welcome back to the program. We're talking about some of the important distinctions in terms of what consumers are looking for when it comes to financial services these days. Interestingly, based upon a most recent survey, tax planning, tax advice actually jumped to the #1 spot ahead of retirement planning. Now, that could be the time of year, right? We're in January, so probably everybody's got taxes on their mind. But Christina, as we were talking about in the prior section, there really is a distinction between giving kind of general guidance and being very specific in terms of providing detailed tax advice, right?
Absolutely. As we had said earlier, there are so many rules and regulations and nuances to the tax code. You know, running a bona fide tax projection is really important to understand how the income is really going to affect your tax return, not just adding to it, but the other implications that flow through on the return.
And so important to actually do the return using software that has the tax return programs inside of it. So it's not just some written out on kind of a piece of paper kind of plan. And I think that's important because, you know, we hear all these ads about tax-free retirement. And obviously that gets a lot of people's attention, but there's definitely a cost in order to get there. And so before the break, we were talking a little bit about that distinction between IRA versus Roth. And so when you talk about tax-free retirement, you start to get into the conversation about Roth, more specifically about converting your IRA over to a Roth. And that's a concept that I suppose is more available now than it used to be, because back in the old days, you had to have it below a certain level of income in order to do the conversion in the first place.
Yeah, back several years ago, you had to have less than $100,000 of income to even consider the Roth conversion, which is now much higher and, you know, opens it up to more folks, and as does the internet open these concepts that people don't totally understand before, you know, they jump in and try and do some of these things.
Well, and for our regular listeners here on Dollars and Cents, you know that last week, or maybe it was the week before, we talked a lot about kind of Washington's push to really promote the Roth. And you have to understand, you know, the sort of the bias of government when they want to promote things. What's the reason behind that? And when you look at the difference between Roth versus IRA, Roth and the push towards Roth clearly generates tax revenue now because you're putting after-tax money into the Roth. When you convert IRA to Roth, you're paying all of those taxes on an immediate basis based upon the amount that you are converting. So there's really some important things to be thinking about, particularly if Washington is pushing it, you know, right there on the surface. And maybe I'm, you know, probably a little jaded at this stage in the game, but if Washington is promoting it, I don't know that that's necessarily the best idea that I want to gravitate to.
Right. There's definitely a reason for them promoting it, which is generating tax revenue.
Correct. So to come back to the concept, I mean, in terms of getting a tax-free retirement, you do have to pay taxes on the amount of the conversion. That goes into the tax return. What's the implications of that, Christina?
Well, that's adding to your income. Right. So let's say you made $100,000 and you did a $50,000 Roth conversion. Now you have $150,000 of income on your return, which is at the marginal rate. So your tax rate may jump up. Other implications could be, you know, increasing the amount of Social Security that's taxable, changes in the amount you pay for Medicare, like Joel mentioned earlier in the show, changes to the capital gains rate that you pay, changes to net investment tax or initiating the net investment tax. All of these things can kind of tumble into the tax return just by doing that conversion and adding to your income.
Yeah, so when you're doing a conversion, it's almost like throwing a pebble in a lake, right? You see the ripples, okay, and the ripples will go out for a long period of time. I do think that's a good example, Christina, about, you know, if I got 100,000 and I do 50,000 of a conversion, then okay, then that means that $50,000, that's all coming in at my highest marginal tax bracket.
Absolutely.
And that's the concept that folks don't quite appreciate is if I've got normal level of income and then I do a conversion, it's coming in on that higher tax level. And so if you're retired and if you're making, say, $10,000 a month, the reality is with a standard deduction, you're going to find yourself in the 12% tax bracket. That's
sure, absolutely. For joint filers, yeah.
Yeah, so that's generally where that kind of falls. The 12% tax bracket goes up to about 90% taxable income. You throw a standard deduction on there at $28,000, gets 120, roughly $10,000 a month. So if you're less than $10,000 a month, you're in the 12% bracket. So if you then do a conversion, that conversion is going to cost you at 22.
Yeah. And why would you want to pay 10% more?
Correct. So combined with the old concept of the time value of money, the opportunity cost, I mean, those are dollars that are out the door that are not sitting in your checking account. They're sitting in the IRS's checking account.
Or not staying invested.
Correct.
Because you had to pay those taxes. So you're also losing the growth potential.
Certainly a lost opportunity cost. No question on that. And I understand the argument. I think some of the arguments for conversion are certainly valid. Tax rates are low now. A couple of years they're going to jump up. But even that, I think, doesn't necessarily hold as much water as I think people give it credit to, because maybe the 12% might go up to 15 if we think back to what those rates used to be, but 15 is still less than 22. So
absolutely. Or maybe it is a little bit more intriguing for younger investors, because that growth potential of the Roth IRA is there for them, whereas older folks, they're not going to have as long to really gain from the tax-free growth.
No, that is a very good distinction. I think if you're in your 20s or your 30s, the reality is that Roth option, particularly with today's tax rates, is a great idea. But that hasn't been around that long.
No.
I mean, think about 401ks. Now, the Roth has been around for a while, but the ability to say do a Roth inside your 401k, that's only been around for a few years.
Yeah, that's very true. And that's where most folks really do invest the most, especially in the younger years. They're not thinking, to have as much financial planning as somebody in their 40s, 50s, or 60s. And
so what we do when we're having these conversations about Roth conversions and things like that, and I think this is the important takeaway for our listening audience, is that we're going to run an actual tax return. We're going to run an actual projection based upon all of the ripples that throwing that pebble into your tax lake is going to create, and ultimately, in order to make the best possible, most informed decision on it, but before you do that. So for those that are kind of intrigued by that tax-free retirement concept, don't quite jump at the concept until you understand all of the numbers.
Absolutely. And that's why you get a financial advisor involved, like ourselves.
Correct.
Hopefully one that has the tax experience to provide you all of the ripples in the equation.
Correct, because you have to understand all of that piece of it. So it's so important. It goes back to that sort of the consumer survey where, the tax advice, the tax planning, so important and so crucial in today's world as well. So for those of you who are listening to the program, this, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars, such as, should I do a conversion? How do I get to a tax-free retirement? What's the catch, if you will? There's certainly a cost to it. If you're a regular listener to the program, well, then you know that you can catch us on any of our podcast channels as well. If you have any trouble finding our channel on your favorite platform, just go to our website. That website is Nelson Financial Planning. There you'll find a bunch of icons. Click on the one that looks most familiar and you'll get immediately connected. Once there, make sure you subscribe, because that way you won't have to go through that process of finding us again. You also can go to our YouTube channel if you want to see Christina and myself coming to you live on camera, or I guess recorded on camera. So check us out on all of those various channels. We're going to slide to a break. When we come back, we're going to talk about the latest on the employee retention credit. Coming up next here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. So this segment of the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Joining me on the program this week is Christina Lamb, a fellow certified financial fiduciary, a longtime associate with Nelson Financial Planning, also happens to be an IRS enrolled agent. So when we talk about this particular tax credit, Christina, this is kind of right up your alley in terms of your background.
Yeah, absolutely. We've had so many questions from clients regarding the ERC, which is the Employer Retention Credit.
And the interesting sort of backstory on this is this was a very popular kind of COVID pandemic relief tax credit that provided people with up to $26,000 per worker. But it was designed really to help those employers who were trying to do the right thing, keep people on their payrolls back in 2020, back in 2021, when large parts of the economy were shut down, to give them sort of an offsetting tax credit to help those employers that were still retaining those people still on that they were still trying to pay, even though maybe their business wasn't open. So think
right,
like
they really
restaurants.
couldn't afford it.
Right.
So they're trying to keep their employees, trying to keep their business open. And struggling because they really couldn't afford it. They didn't have enough business. So, well, I mean, it became but the interesting thing that happened is, I guess this is sort of in the category of no good deed goes unpunished. What sprang up was sort of this cottage industry of companies that were really reaching out to employers to claim this credit. And really encouraging employers, particularly over the past year or so, to amend those 2020 or amend those 2021 returns to claim this credit. And the disturbing part of it is that these firms, sort of this mini cottage industry that sprung up, was charging like 20% of the refund that employers were getting in order to apply for this credit. And right there, as we've certainly said many times on the program before, if your tax preparer is charging you, right? Red flag.
Yeah, that's a big red flag.
Well, charging you based upon the refund, a percentage of your refund. Anything to do with tax that's a percentage of a refund should be a red flag to anyone.
100%, because then there's no incentive to actually see if the return is being done on a regular basis, because if you're getting a percentage of the refund, then you want the refund to be as much as possible, and so you increase it to be as much as possible. So let's take a minute, because there's an update that we want to provide on this employee retention credit here in this segment. Let's take a minute and talk about, kind of who is eligible in the first place, because obviously this is a powerful credit, useful credit for many employers, many businesses out there. So let's talk about eligibility so we have an understanding of what this is.
Yeah, so there was very specific eligibility requirements for ERC. So the first one was sustained full or partial suspension due to an operation. Mm-hmm. The big one that I think most folks would fall under is experience a significant decline in gross receipts during 2020 and 2021.
So your business had to have been suspended, basically closed down, not able to operate, and then to meet some of the other parameters in terms of, you mentioned significant decline. So in the eyes of the IRS, what's that significant decline amount? How do you measure that?
And per the IRS, it is a bit convoluted. So generally, you're comparing the same quarter in 2020 to 2019, and for 2020, there had to be a 50% decrease in gross receipts. And then for 2021, that jumped up to an 80% decline in gross receipts to continue claiming the credit per quarter
Yeah, so it's not some arbitrary, oh, you know what, a couple employees missed work because they were sick, because they, had to got COVID or whatever the case may be. I mean, 50% decline and 80% decline. Those are definitely some dramatic thresholds that you had to meet to apply for this particular credit, right?
No, absolutely. And I think here in Florida, we were pretty lucky. As far as the whole United States go. But in a lot of states, businesses were completely shut down.
Right.
And I think those are the people they're really trying to help.
Sure, and that was certainly the concept of it. But unfortunately, good concept gone bad. At last count, they had issued out refunds like triple the amount that they expected to, because I guess there's confusion over what exactly a significant decline means, and 50%, 80%, that kind of would be significant, but it has to be qualified wages as well. So there's a concept there that we need to understand too.
Right. So qualified wages are wages that were subject to Social Security and Medicare taxes. And I think one of the stipulations that also have to deal with wages is if you applied and used those wages for the PPP loans, you cannot also use those for the ERC.
Yeah, and that's a good example of, obviously, during that period of time, there was a lot of options out there, right? So you could do ERC, PPP, there's even a host of other programs, but you can't double dip.
Right.
I mean, you can't use the same, there's these wages, I'm going to get PPP money over here, payroll protection program money over here, and then, I'm going to now also use that for ERC.
Yeah, exactly. And that's the really sad part. Folks come to these people because they don't know the difference between all of them, and they're going to somebody who's just giving them poor information and then taking the 20% and basically running.
Yeah, no, and running is a good analogy. So last September, and we certainly shared this update with you back in the fall. So in September, the IRS just said, hey, wait a minute, we're going to stop all the processing of all of these returns that are still flooding in as a result of this cottage industry that's sprung up to say, oh, let me get you your ERC credit. But the reality is that they also gave employers back in September the opportunity to sort of take back, no harm, no foul, take back your amended return. And at that point, employers withdrew like almost $100 million of claims of this ERC.
Right. I mean, it was huge. It was basically giving the employer the ability to say, wait a minute, let me look at this. There would be no legal ramifications or penalties assessed to them, but they would have to pay back a good portion of their ERC.
Right. It's not a tax credit that you're eligible for. And now what's interesting is, and this is the update that we wanted to share with our listening audience, just a couple of weeks ago, there's a new offer from the IRS, because again, this really it was such a big industry that spurred, it seemed like every client and every friend, every person that it seemed like we were
anyone who had a business.
Right. You were literally getting inundated with emails, with phone calls, with oh, you're eligible for this credit, and let us do it, and we'll take care of it, and you don't have to worry about it, and we're only going to take 20%. And so a lot of businesses wound up taking advantage of that. So and again, there's such a backlog, such an issue. The new offer that the IRS came out with here just a few weeks ago was, okay, fine. If you pay back 80% of what you got, right? Then and that sort of recognizes that most of these ERC tax firms, the mills, if you will, took 20%.
Right.
So the deal that the IRS offered was, well, look, if you just pay back 80%, which is sort of the amount that you actually wound up getting, then hey, we're also going to put it into that category of no harm, no foul.
Yeah, exactly.
Which, fair offer. The catch on that, if you read the fine print, is if you're going to do that, they would like to know the names of the ERC firms and the individuals that you worked with and a description of their services. In other words, if you're going to take advantage of the IRS's latest offer, they kind of want you to rat out your tax preparer.
Yeah, absolutely. But, I mean, hey, you took a credit that you shouldn't have.
And a lot of these firms, and I think that's the heart of the issue, a lot of these firms sprung up and ultimately really encouraged people to do things that at the end of the day, they really weren't eligible to be able to do, and then they took a 20%, override on it. Now, to qualify, you got to notify the IRS for this particular latest offer on the ERC. Got to notify the IRS by March the 22nd in order to be able to be eligible for this latest sort of offer that
only
results.
Pay the 80%
Correct, on the employee retention credit. So we're going to take a break. When we come back, we're going to talk about some of the health benefits of budgeting. Coming up next here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. If you're a regular listener to the program, you know we like to talk about budgeting on the show. Christina, I know last summer you and Rob did just a great show about budgeting where you took that word budget and created an acronym out of it. Why don't you refresh our listening audience and for our new listeners kind of what that budget word really stands for?
Sure. That was actually one of my favorite shows to record. It was a good one. But the acronym for budgets was B is for balance, U is for understanding, D is for debt, G is for goals, E is for expectations, T is for transitions, and S is for solutions. So if you didn't hear it, it did air on July 9th, so you can help yourself by learning how to best plan your budget.
Certainly check it out. Good opportunity to sort of check it out on your favorite podcast platform or go to our YouTube channel as well. Any trouble finding us on any of those channels, just go to our website, Nelson Financial Planning. You'll see the icons. They'll direct you directly to our channels on those platforms. Once you're there, make sure you subscribe, and then you're going to get updates of when we upload new content, which, of course, is every week because we do the show every week. Another great resource, in addition to kind of the radio program and specifically that July 9th episode where you and Rob talked a lot about budgets and kind of what the different parts of that really means is our book, right?
Absolutely.
Next Gen Dollars and Cents, our new book that we wrote last year. We will hold up a copy of the book for our YouTube audience, Next Gen Dollars and Cents. There it is right there. Free offer of the book ends on January 31. So once January 31 goes by, you'll have to go to the folks at Amazon and pay for a said book. We are offering, or we extended our free offer of the book past December 31 into January 31st. Still yours to be able to claim. To claim it, go to our website, Nelson Financial Planning. Just put in your name and address. We'll send you out a free hard copy. But in the book, there is a chapter on budgeting.
Yes.
As you would expect in a book designed to create
Financial
tools,
planning.
strategies, and things like that to generate financial success, but also some good QR codes in there as well.
That's exactly what I was thinking. There's some QR codes in the back that will help you create spreadsheets to generate your budget.
Goes directly to basically an Excel spreadsheet that we created in-house here, relatively robust sort of budgeting type of spreadsheet that you can go directly to there and download it. And that's available, of course, on our website as well. So, interesting. It's kind of interesting to hear some of these more recent studies that deal with budgeting, particularly one that we saw of late that talks about the health benefits of budgeting, which sort of makes sense. I mean, if you're having financial constraints, then that creates stress, right?
Correct. Yep.
And it's somewhere, there was a survey recently where like 64% of Americans said that money is a significant source of stress, and only like 39% of Americans can cover or can comfortably cover an unexpected expense of $1,000. So, and then you throw in the pandemic and increasing stress across the board. Now, not a doctor, but stress is probably not healthy, right? Raises blood pressure, heart rate, all of those kinds of things. And the reality is, a recent study with Northwestern Mutual, 92%. That's pretty good. 92% of Americans said that nothing makes them happier or more confident in life than when their finances are in order. So, Christina, without further, let's talk about some of we've identified 5 health benefits, if you will, of budgeting. What comes first on the list, if you will?
So, number 1 is budgeting can reduce physical symptoms of stress.
Okay. All right, that makes sense, because if you're budgeting and you know where you stand, helps to reduce the anxiety that comes with not knowing sort of where you stand.
Right. It's that that feeling of not knowing and sort of being out of control. So if it is planned, it helps reduce some of that stress because you know where you stand.
Knowledge is always power, right? Knowledge is key to whether it's your finances or any other item, certainly understanding that as well.
Mm-hmm.
So other studies have concluded, in addition, some additional health benefits to budgeting as well.
Sure. So that would be bringing down physical stress symptoms, taking away muscle tension, stomach aches, and high blood pressure.
Yeah, so all good things. So, rather than go to the pharmacist, go to our website and download the free budget, and you might wind up being healthier as well. Another, health benefit of budgeting that some of the studies have concluded is it actually helps create a better immunity system, if you will, for people.
Yeah, and with reducing any stress, not just with budgeting, can help reduce your stress, which helps boost your immune system. And so when you have less stress and you have good immunity, you're going to look healthier and not get sick as often.
That's important, because if you can stay away from being sick, then that stuff doesn't cascade into something worse. And then if you stay healthy, what's the added benefit of staying healthy?
You'll live longer.
You live longer, which is good. But you also reduce the cost of your health care too, right?
Yeah,
so you don't
absolutely.
you don't have to pay as much for, it doesn't matter what insurance you're on. You probably got some copay when you go see the doctor. That's for sure.
Right, and that's what leads to number 3 is budgeting can help with your health care by being able to afford things such as preventative care, gym sessions, massages, which is one of my favorite, and eating healthier and going to maybe like a whole food sort of diet.
Yeah, because certainly the organic or the healthier foods are certainly cost more, and if you go to the grocery store these days, everything costs more. So finding that a lot of folks are kind of having to make those choices when they go to the grocery store these days. Other health benefits of budgeting. What's next on the list?
Next one is not overextending yourself. So
that certainly would make some sense.
I thought this one was interesting, basically stating that, this month there's no room in my budget for that. So as a way to say no to social activities or things that you're just too busy to kind of fit into your schedule, you use your budget as a way to say no if that's kind of hard for you to do.
Well, it also helps, not overextend yourself. Also reduces stress because you're not constantly being busy.
Yeah,
So that
absolutely.
certainly makes sense. And then lastly, I guess it does help you to live longer and build the life that you want if you're rolling on a budget, right?
Yeah, basically, your budget reflects your personal values. So when you're able to have that a little bit more organized, you're feeling healthier and happier, and happiness generally reduces stress. So makes it life a little easier for you.
There you go. So yes, indeed, the health benefits of budgeting. See, you think it's all about finances, but it really is all about your entire quality of life at the end of the day that we talk about when it comes to money.
Yeah, absolutely. I think it comes down to happiness, and we don't like to say money generates happiness, but to some extent, you do have to have money to do the things that make you healthier and happier.
That is for sure, because certainly there's always choices that you can make with your money, but if you are managing it, keeping track of it, using a budget, then it really does help in so many more ways than just financially.
Yep. Absolutely.
Well, we're going to wrap it on up and get on out of here. Christina, thank you as always for joining me on this week's program. We certainly appreciate that. Next week on the program, fellow certified financial fiduciary Rob Field is going to be joining us. We're going to be talking about the Corporate Transparency Act. Maybe you've started to hear about this one, but there's a lot to unpack on this in terms of what you have to do if you have a business, and you have to do it by the end of the year. So we're going to be talking about that on next week's program. In the meantime, thank you for listening to this week's program. This has been another episode of Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. Make sure you go to our website if you have any questions or would like to set up an absolutely free conversation so that we can help you with your finances.